Hey, Steve, we just wrapped up our 76th consecutive ISG Index call, so let's jump straight into a recap of the data. So, Steve, the combined market ACV for the third quarter was up 40% year over year, and that's the highest growth rate ever for the combined market.
Yeah, great talking to you again, Stanton, and you're absolutely right. It has been a crazy quarter. We saw 6 mega deals awarded this quarter, and the ACV of the 5 mega deals in the Americas broke the all-time record. Cloud adoption remained high, which really helped push the ADM space to new levels. And sort of to put this all into context globally, we added almost 6.2 billion of new ACV in the market since last fall. Even more encouraging, we really saw growth both in managed services and the as a service. Both reached new quarterly highs. And I think we've just seen a strong return of tech spending.
So, Steve, while demand looks really strong, the overriding concern in our market today is finding and retaining digital talent. And of course, that's putting huge pressure on both our enterprise clients and on service providers.
Yeah, we spent a lot of time on the index talking about this. And as you know, Kathy did some great research on it, our chief data officer, and really kind of looked at where things were from a rate standpoint. I think it is the biggest concern and biggest headwind that we have. I mean, we're hyping it as the great resignation, but I think in so many ways it's so much more. I think there's a real talent shortage in the industry right now. And I think, quite frankly, it's being fueled by the digital agenda. I think right now, demand is just literally outstripping supply. You know, attrition's high. We knew it was going to be high coming out of COVID. I think in many ways it's nearly all times high. So I think we talked about on the index that it's 5 to 10% higher than what typically reported, 500 to 1,000 basis points, which is pretty significant. In India, we're really seeing high attrition rates, both, in so many different organizations. And we've heard different stories of, young digital talent, 50% are moving to different things. So some of this is the market. Some of this is how they perceive value. Some of this is how enterprises, manage through the pandemic. But either way, it's all impacting it. So, I would say the providers are pulling really all their levers. They're adding talent quickly. They're increasing campus hires. They're doing more lateral hirings. They're using more subcontractors. But Stan, both of us know it takes time to ramp up those resources. There's additional training costs. There's the added pressure of more expensive resources. You're taking people and putting them into deals where you don't necessarily have the permission yet to increase rates. So it's hard. And I think when you look at all that, we're going to continue to see quite a bit of margin pressure. I think we all understand it, but the fact is most of the deals that we do are 3 to 5 years. They've got contractually obligated rates. They've got contractually obligated inflation, adjustment clauses in there. So it's not just that easy to raise them. I would say, though, what we are seeing, though, is on a project-by-project basis, service providers are able to increase the rates. I think in new deals, we're seeing some rate increases. And I think Kathy mentioned on the call that we're sort of seeing sort of a 4% increase from 2019 to 2021, which is encouraging, and hopefully that will help hold in the market. But, as we go forward, service providers are going to have to shift to automation. They're going to have to continue to implement process improvements. They're going to have to shift to less labor-intensive roles and even move to nonlinear revenue strategies just to continue to grow the top line and address the bottom line challenges that they're going to face over the next several quarters.
So, Steve, let's move to managed services, which came in at nearly 8.5 billion in ACV. That was up 22% year over year. But I think what's really interesting here, Steve, is the fact that we had a record number of awards this quarter, 564 awards. That's the most since 2019.
Yeah, it was really encouraging as well. I agree with you. The number of awards, really showed sort of the strength of the industry. Last quarter, I think we thought it was a bit of pent-up demand. We saw the numbers. We saw a high number of awards. But we continue to see strong growth across the industry and even within our own pipelines. It truly is encouraging. And as you said, Stanton, we had 6 mega deals, 5 in the U.S. and 1 in EMEA, that really helped the managed services growth. But even if we normalize the ACV for those mega deals, we still would have seen, the robust deal activity and still would have seen growth on the top line ACV.
So Steve, you mentioned applications earlier. On a year-to-date basis, ADM was up 29% versus 2020. And as we talked about the call, we really do think that infrastructure as a service and just cloud in general is driving applications growth and is going to continue to do so for quite a while.
Yeah, you're right. Apps now account for 60% of the IT deal flow and almost 55% of the ACV. We've seen 3 consecutive quarters of ACV greater than 3.2 billion, and will easily break the all-time record for ACV awarded in the app space this year. This is all driven by software eating the world, as you've mentioned multiple times. The faster we move to the cloud, the more apps modernization and refactoring work we take on, and the more important it is to continuously improve the user experience and data insights. And I think, you and I have had some really healthy debates on the impact of this trend on traditional data center and ITO deals. From my perspective, I think we'll continue to see a decline in traditional infrastructure spend, though it may rise slightly in 2022. Over the last 2 years, we've lost $1 billion per year in data center ACV. And this year looks like we'll add a little bit, but just slight gains from 2020. And the ACV for the full ITO sector is down significantly, and it's going to be hard to get back to any kind of new normal. The investments in multi and hybrid cloud solutions is amazing. And from my perspective, I just don't see clients or boards reinvesting in data centers. Any thoughts there from you?
Yeah, I think it's more, Steve, honestly, more about the timing of when this change is going to happen. I think we're both in agreement, right? This is not a growth market. My perspective is I think it's going to probably continue to bounce around sort of in the billion to $1.5 billion range for at least a few quarters, mainly because of the amount of legacy infrastructure inside of our clients' environments, specifically mainframe in areas like retail and insurance and banking. My view is that on the whole, those are getting progressively modernized, and that's going to take time. But I think we're both in strong agreement that this is not a growth market and it's going to continue to shrink.
Yeah, no, I think that's absolutely fair, and you're right on the timing. There's still a lot of legacy apps out there.
Okay, Steve, BPO was up 40% year to date, but most of that growth is coming from engineering services, which was up almost 300% year to date. And as we talked about on the call, and as Gaurav covered, this is a red hot area that's not only growing rapidly, but also rapidly consolidating.
You could almost put apps and digital engineering in the same category, Stanton. Both are being radically transformed through digitization and customer experience. Digital is taking over the physical world with digital twins, analytics, IoT, Industry 4.0, and a host of transformative technologies and business cases that are driving increased investments in engineering. And as you and I have discussed previously, we really are seeing this big move towards rethinking through organizations, rethinking through their whole engineering piece. It's changing vehicles, it's changing factories, it's changing cities, it's changing really all aspects of it. It's a great place for the global service providers to play. And I think as you and Gaurav talked during the index today, I think we're going to continue to see that expand at tremendous levels.
So Steve, as a service had its best quarter ever with almost 13.5 billion in ACV, which was up 55% year over year. And on a year-to-date basis, we saw a really strong return of SaaS ACV. That was 7.7 billion, and that was up 26% year-to-date. And I think really what we're starting to see here is some of these big transformational SaaS implementations starting to come back online after a pause in 2020.
Yeah, I agree. I didn't get a chance, Stanton, to look at the SaaS numbers as much as we looked at the managed services numbers this index. But I think you're absolutely right. We did see this much bigger flow of transformational deals come through. I think what will be interesting on the SaaS side as it continues to grow, will we see that flow through with the traditional managed service providers, or will it continue to sort of be SaaS growth, but you don't see the associated growth on, sort of that traditional SI space? That's been a question for the market for some time, and I don't know that we have the answer for that yet.
Okay, Steve, let's close out with our forecast and the fact that we've actually raised both our managed services and as a service forecast for the full year.
Correct. There's so many positive signs that we did increase the forecast on managed services 100 basis points to 10.1%. And just to clarify, because I know this came up with this question, this is the forecast for revenue for all of the service providers in the managed services sector. We clearly think that the ACV will rise more than that, but ACVs are bookings the insights that we provide are both for bookings and clearly for the revenue. So we did raise it. We think it's going to be quite healthy. And as you said, Stanton, as well, we also raised our forecast to 25% for the as a service market. Again, we're just seeing rapid growth within that. We think that's going to continue. You mentioned the growth of SaaS. We're already seeing the growth of all the hyperscalers. And I think it's going to be a very strong year in 2021.
Awesome. Thanks, Steve. And as a reminder, if you're not already subscribed, I publish a weekly briefing on the state of play in IT and business services, and you can subscribe to that research briefing via the link below.
Great talking to you again, Stanton. Thank you.
Thanks, Steve.
For more details, please visit the ISG Index page on our website, www.isg-1.com.